On year 2021, now the land was sold 5 crores and another land was purchased for 3 crores. So 5 crores and 3 crores. The company reported cash flow on the net basis and 2 crores is invest in activity and from the sale of land. Advise the treatment given above correct or not on the provision of India 7. Calculate the cash from operations or indirect method from the following method. So cash flow three types இருக்கு. Through investing, through financing, through operations. So investmentingல cash outflow is 5 crores. Cash outflow is 3 crores. Cash inflow is 3 crores. Net effect is 2 crores. So in sales, we can say operating cash sales 20 lakhs. Cost of goods sold to for 14 lakhs, administrative 2,20,000, depreciation 28,000, interest paid 12,000, and loss on sale of asset 8,000. Profit after the 3 lakhs, tax. Non-current asset, balance sheet, current asset, non-current asset. Asset increased by 40,000, investment increased by 8,000, inventory decreased by 4,000, trade receivable increased by 12,000, cash and cash equivalent increased by 4,000. Shareholder fund for 40,000 increase, non-current liability decreased by 8,000, trade payable increased by around 16,000, trade expenses increased by 12,000. The correct transaction cash flow. It's nothing specified mentioned as per the India 7. The cash flow is presented at the gross basis. The gross basis means a receipt should be given separately and the payment should be shown separately. According to 2021, while presenting the information, entity will show separately cash flow of investing activity 3 crores of purchase of land and the cash inflow and from the activity of 5 lakhs from sale of land. அவ்வளவுதான். Cash flow from operating on indirect method. Indirect method profit after tax 2,16,000, 2,12,000. As 2,12,000 cash add depreciation you need to add, loss of asset add, interest paid add. So loss of asset add, interest paid add, depreciation add through for profit and loss account. Add பண்ணிட்டோமா and decrease in inventory. Value say decrease in inventory, cost of goods sold, administration overheads, inventory value. Yes, inventory 4,000 தானே? Increase in inventory add back. Increase in trade receivable 12,000 and increase in trade payable, increase in tax payable 2,000. So 2,80,000. So that we'll get 2,80,000 here. Cash balance is 24,000. Cash flow from operation from indirect 2,80,000. Where how do you find this 2,80,000? Okay. Operation. Operation is 2,80,000. Okay. Correct தான். 6 lakhs. 6 lakhs minus 2 lakhs. 3 lakh after tax, before tax, tax 1,20,000. So 2 lakh 12,000 இருக்கா? அதில் 8,000, 12,000, 20,000 add பண்ணோம்னா you get this 80,000. Okay. Pharma Limited is a manufacturer of surgical items. Pharma Limited shows a net profit of 50 lakhs in the second quarter. And for the additional adjustment, we had made the while computing the following net profit. Adjustment was made while computing the net profit. Bad debt 2,60,000 incurs during the quarter, and 40% bad debt has been deferred in next quarter. Incurred, அது அப்படியே பண்ணணும். 40% deferredலாம் பண்ணக்கூடாது. Additional depreciation 520,000 resulting from the change in the method of depreciation. Okay. Exceptional loss of 8,60,000 incurred during the second quarter. 60% exceptional losses to be deferred next quarter. 6 8 complete இது பண்ணிடணும். For complete should be recognized. 4,70,000 expenditures on account of sale expenses particular to the second quarter's default to the argument that third quarter will be a more sales. Therefore, the third quarter should be debited with a higher expenditure. Expenditure is uniform throughout all quarters. Then that's correct. Analyze the ascertain of the correct net profit on shown in the interim financial result and the second result, second quarter to be presented to the board of director in DA 34. In this instant cases, the quarterly net profit has not been correctly stated. As NDA 34 interim financial state reporting, the quarterly net profit should be adjusted to the resulting show. Plus, treatment of bad debt is not correct as the expenses incurred during this inter-import accrual concept, prudence concepts. Prudence and when the expenses happen, we should incur. And this importing period should be recognized as same as an actual period actually. So 1 lakh should be deducted from 15 lakhs. Why 1 lakh 80,000 we are saying 2 lakh 40,000? 40% has been deferred. Now that 40%, that 40% is 1 lakh 4,000. Correct. 2 lakh 3,000 40 percentage 1 lakh 4,000. That should be different from 1 lakh 50,000. Correct. I recognize additional depreciation 5 lakh from the same quarter is set correctly. Correct. The treatment of exceptional losses is not as per the principle in DS 34. The entire amount 8 lakh 50,000 to be incurred during the third quarter should be recognized in the same quarter. So hence 4 lakh 86 8 4 lakh 89,600 is deferred during the deduction from the third quarters only. Okay. Like from the profits of the third quarter only. Okay. Account, as per NDA 34, the income and expense should be recognized when the earned and income respectively. As per the para 39 of the NDA 34, the cost should be anticipated and deferred by one. It is appropriate to anticipate and defer the type of cost at the end of the financial year. The cost incurred unevenly during the financial year of the enterprises. Therefore, treatment is done relating to for like 70,000 is not correct and the expenditure uniform throughout the year. It's not correct. Expenditure uniform throughout all quarters. Thus, the consideration above the correct net profit 50 lakhs minus 1 lakh from bad debts exceptional loss 3 lakh 90,000 add back பண்ணோம். Um, so last பண்ணோம் and 3 lakh 89,000 this for 816,000 into 40% is an 16,000 into 40% is 3 lakh 26,000. 4 lakh 8,600 sales expenses wrongly debited 4 lakh 70,000. Oh, like அந்த வருஷமே கழிச்சு விட்டுரும். So the net wise profit is 39, 13, 39, 36, 400. Correct. Next Limited has a loan facility from the bank which is had to repay in the period of 6 months from the end of the reporting period. Before the end of the reporting period, X Limited and the bank enter into the arrangement as to which existing outstanding loan will unconditionally roll with a new facility and will expire in the period of 3 months. How would your loan be classified in the balance sheet? Current liability. Will be the answer different. The new facility is agreed upon after the end of reporting period. Why and what would be the answer? Agreed upon. New facility will expire. Okay. And what are the answer different? The new facility is not yet tied up with the existing bank. Excellent potential to redefine the application. Answer. The loan is not due for the payment at the current reporting period. Upon non-current liability entity, the bank has agreed to set the rollover because of the end of the previous year or end of the reporting period to the period of 3 years. Since the entity has unconditional right to defer the settlement of the liability for at least for 12 months after the reporting period, the loan should be classified as a non-current liability. Yes, the answer will be different with the arrangement rollover is agreed upon the end of the reporting period. Since the assessment required to be made based on terms of existing loan facility, as the end of the reporting period, the entity does not have any unconditional right to defer the settlement in the liability. So that last 12 months after the reporting period will be considered as current liability. Yes, the answer will be different if the loan will be classified as a current. It is because, as per the para 73 of India's one, and redefining the rollover obligation is not in the discretion of the entity. For example, there is no arrangement is redefined. The entity does not consider the potential to redefine the obligation and classify the obligation as current. Hmm. On December 22, Limited entered into loan agreement with the bank. The loan is repayable in 5 annual installment commencing 1st October. One of the material provision of this loan agreement that Limited should create an equitable mortgage on the asset in favor of the bank on 31st March. Failing of which loan will be payable on demand. Limited is not able to create an equitable mortgage on 31st March. In April, Limited started negotiating with the bank and requested it does not demand payment due to non-creation of equitable mortgage. Meanwhile, financial statement FX on 31st March is approved on 3rd May. The month of the June, the bank agreed to payment would not be demanded. Immediately, the consequence of breach of the material provision, how would you loan liability? 31st March, the act should be done. If not be done, it will remain payable. On 31st March, on the file, act has not been done. Then what? It became current liability. But the reporting date is May, and it is agreed on the day of the events happened after the signing the audit report. Events after happening after the due date. That's how we consider. Liquid the general instruction preparation financial statement complete with the requirement of India. Yes. Okay, that's a very good question. General instruction preparation of financial statement of company required to comply with India is every company to in which India is applied shall prepare the financial statement according to Schedule 3 or with such modification as may require under certain circumstances. When the compliance with the requirement of the Act, including India, except the option of presenting assets and liability in order of the liquidity provide the relevant India applicable to the companies require any changes in treatment or disclosure, including addition, amendment, substitution, deletion, head of subheaders of the charge inter alia. The financial statement or the statement forming part of therefore the same shall be made the requirement under the Schedule 3 and shall be modified accordingly. The disclosure requirement, Schedule 3 is an addition, it's not a substitution, it's an addition or not in substitution to the disclosure requirement specified there in DES. The additional disclosure requirement of NDA shall be made in the notes by way of additional statement. Additional statement unless required to be disclosed in the phase of the balance financial statement. Similarly, at the disclosures are required as per Companies Act 2013 shall be made in the notes in addition to the requirements set out by the schedule. Note shall contain information in addition to the prescribed in the financial statements and shall provide whether required a narrative description or disagreements in terms of recognized those are statements, information about the items that do not qualify recognition in the statement. Each item face a balance sheet, changes of statement of changes in equity, statement of profit and loss account, and the cross reference to the related information notes. In preparing the financial statement, including the notes, a balance shall be maintained between provide exceeding details that may not assist the user of the financial statement, not provide important information as a result too much aggregation. Depending upon the total income of the company, the figures appear balance sheet shall be rounded off below. Total income rounding of less than 100 crore rupees to be near as hundreds, thousand, lakhs, millions, decimal. Therefore, 100 crore rupees and more than the nearest to lakhs, millions, crores, and decimal, and thousands. Since the unit of measurement is under, it should be uniformly measured. When இதே தப்பு நீ காரணம் 100 மேல இருந்ததுன்னா then nearly lakhs and millions only you can go. You can't go for hundreds and thousands. Financial statement shall contain the corresponding amounts. இது ஏன் சொல்றேன்னா தமிழ்நாடோட ஃபினான்ஷியல்ஸ் தமிழ்நாடோட ஃபினான்ஷியல்ஸ் பார்க்கும்போது ஃபினான்ஷியல்ஸ் வந்து தௌசண்ட்ஸில் கொடுத்துருப்பானுங்க. பட் 100 crores மேலே டோட்டல் இன்கம் இருந்ததுன்னா இட் க்ரோஸ் இன் லேக்ஸ், மினிமம் லேக்ஸ் செலக்ட் ஆகும். வேல்யூ கூட வாங்கக்கூடாது. The financial statement shall contain the corresponding amounts comparative to the immediate preceding financial year. The item shows financial statements including notes except the case of financial statements laid before the companies after incorporation. Financial statement shall disclose the material items. Information is material if omitting or misstating or obscuring in the case of reasonable to be expected to influence the decisions that the primary user of the general purpose financial statements make on the basis of those financial statements, which provide financial information about specific reporting entity. Materiality is depend on the nature of magnitude of information. Both the asset equity assesses whether the information either individually or in combination with the information is material to the context of the financial statement or taken as a whole. The information is skewed in the communicated in the way that would be similar effect in the primary user of financial statement omitted in the mid handling of the information. For the purpose of the schedule, the terms might be therein shall be meaning assigned to the Indian Account Standard where all the act and regulation require specific disclosure to be made in the standard financial statement of the company, and said disclosure should be made in addition to the requirement of the schedule. Balance sheet, name of the company, balance sheet date in rupees, particulars, notes, figures in the end of the current reporting period, figures in the end of the previous reporting period. Assets, non-current assets. Non-current assets, plant, property, plant, equipment, capital work in progress, investment properties, goodwill, other intangible assets, intangible asset under the development, biological asset, other than financial asset, investments, trade receivables, loans, and others to be split in the fixed asset. Before tax asset, non-current asset. Current asset like inventories, financial assets, investment, trade receivable, cash and cash equivalent, bank balance other than above, loans to be other to specify. Current tax asset, other current asset, total assets, equity, liability, equity share capital, other equity, liability, current financial liability, borrowings, lease liability, trade payable, total outstanding dues in micro enterprises and small enterprises. Total outstanding dues creditors other than micro enterprises. Other financials, other specified to be provisions, deferred tax liability, other current liability, financial borrowings, lease liability, trade payables, total outstanding dues to micro enterprise, small enterprises, total outstanding dues creditors, other micro enterprises, small enterprises, other financials other than specified to the thing. Other current liability, provision, current liability, other equity liability. Statement of changes in equity, equity share capital, current reporting period. Balance at the beginning of current period, changes in equity share capital due to prior period, restored balance in beginning of the current period, changes in the equity share capital in the current period, balance in the end of current reporting period. Previous reporting period, balance beginning in the previous reporting period, change in equity share capital due to prior period errors, restored balance beginning to the previous review, and changes in equity capital during the previous year, balance at the end of previous reporting period. Other equity, these are things, share application money pending allotment, equity component financial instrument, reserves like capital reserve, security premium, other reserves, returned earning, debt instrument through other comprehensive income, equity instrument through other comprehensive income, effective portion of cash flow hedges, revaluation surplus, exchange differences in transition financial statement for an operation, other items and other comprehensive income, money received against share warrant and a total. Balance at the beginning of the current reporting period, changes in accounting policy prior period errors, restated balance at the beginning of the current reporting period, Total comprehensive income for the current year, dividend transfer to retained earning, any other changes to specify balance at the end of the current reporting period. For the previous year இருக்கும் share application money pending allotment, equity component of financial instrument, reserves like capital reserve, security premium, other reserve specific nature, returned earning, debt instrument through other comprehensive income, equity instrument through other comprehensive income, effective portion of cash flow hedges, revaluation reserve, exchanges differences on transaction of financial statements and foreign operation, other items of other comprehensive income, specific nature, money received against share warrant and total balance in the beginning of the previous year, changes in the accounting policy in prior period errors, restoration of balance in the beginning of the previous reporting period, total comprehensive income, dividend, transfer relating to year earning, other changes in specified balance in the end of previous year. The remeasurement of defined benefit plans and fair value changes returning to the next credit risk of financial liability designed to fair value through profit and loss shall be recognized as part of returned earning. The separate disclosure, such item along with the relevant amount in the note shall be shown as a separate columns, reserves and surplus column. Statement of profit and loss account. Statement of profit and loss for the period ended. Particulars note figures of the current reporting period. Figures of the previous reporting period, rupees in thousands, lakhs, thousands, lakhs, millions, crores. Revenue from operation, other income, total income, expenses, cost of material consumed, purchase in stock in trade, change in inventory, finished goods, stock in trade, work in trade, employee benefit expenses, finance cost, depreciation, amortization expenses, impairment of non-current asset, other expenses, total expenses, profit and loss before exceptional item, profit and loss after taxes, taxes, current tax, deferred tax, profit and loss of the period of continuous operation, profit and loss from discontinued operation, total expenses of discontinued operation, profit and loss from the discontinued operation after tax, profit and loss after period, profit and loss for current period, other comprehensive income item that will not be reclassified to profit and loss account, income tax related to the items that will not be reclassified to profit and loss account, items that will be reclassified to profit and loss account, income tax relating to the items that will be reclassified to profit and loss account. Total comprehensive income from the period, comprehensive loss and other comprehensive income. Earning of equity share, basic and diluted. Earning of the equity share, basic and diluted. Earning of equity share of discontinued operations, basic and diluted. MAC Limited purchase a goods of trade credit of Toy Limited for the 580 lakhs for export. The export order is cancelled. Macmillan decided to sell the same goods to the local market with the price discount. Toy Limited was requested to offer a price discount of 10%. Toy Limited wants to adjust the sale figures to the extent of the discount required by the Macmillan to discuss whether the treatment in the books of Toy Limited is justified as per the provision of irrelevant NDAs. Also, the Toyo entered into the sale deed for official land at 15th March, but registration was done in the 20th April. But before the registration is possible to recognize the sale and gain of the and gain in the balance, give the reason for support answer. As per the relevant provision of the relevant standard, discount offered subsequent to the sale cannot be adjusted to the sales. So the given question toy wants to adjust the sale figures to the extent of the discount requested to max is not justified. As per the relevant provision, sale of land can be recognized if the substantial risk and rewards incidental to the ownership is transferred to the buyer. Recognize only the relating to transfer of title, which is not necessary to recognize the revenue. So, if the risk and rewards incidental to the ownerships are transferred to the buyer, then the possible to recognize the sale and the gain on the balance sheet date before registration. Risk and reward on transfer or nothing. The asset is sold for two different active markets at different prices. Entity enter into transaction both market and can access the price in those market and for the asset of measurement date. In the market A, the price was received 78, the transaction cost of the market is 9, the cost on transportation asset is 6. Market B, the price on the market received is 75, the transaction cost is 3 and the cost of the transportation 6. You are required to calculate the fair value of asset at the market A or the principal market. The fair value of asset in none of the market is a predominant one. If a market A is a principal market asset, that is a market in which greater volume in the level of activities for the assets. The fair value of the asset is measured using the price which is received in the market after taking account of transportation cost. That is 78 minus 6, that is 72. If neither the market is a principal market for asset, the fair value of asset would be measured using the price is most advantageous market. The most advantageous market is a market that maximum amount that would be received in selling the asset after taking the account transaction of cost and transporter cost. That is the net amount that would be received in the respective markets. Because the entity has maximum net amount that would be received in market B. How 78 minus 15. 78, 15, 68, 60, 63. But here 75 minus 9, that's 69. So the less transportation is 15. Fair value measured is 69. Discuss the relation whether the events are the nature of adjusting, non-adjusting, and the treatment needed to be accounting standard of India is 10. Moon Limited won the arbitration award of 25th April for 1 crore. And from the arbitration process, it is evident that the company is most likely to win the arbitration award. The matter approved the financial statement of the year 31st March and 1st May. The management did not consider the effort about transaction, and as it was favorable to the company, and the award came after the end of the financial year. Okay. Adjusting even India's 10, even favorable even need to be considered. What important is whether the condition exists at the end of the reporting period and there is evidence of the same. So the management of the Moon Limited required to consider the winning of arbitration award within even. Zoom Limited as a trading business for mobile telephones. The company has purchased 1,000 mobile phones for 5,000 each 15 March. The manufacturer of the phone has announced the release of the new vision 14th March, but not announced the price. Zoom has valid inventory cost at 5,000 each for the end of 31st March. Okay. But due to the arrival of new advanced mobile phone on 8th April, the selling price of the mobile of the remaining stock dropped to 4,000 each. The financial statement of the company valued the phone at 5,000 each and 4,000 less expenses on sales as the price reduction selling price effect 31st March. Adjusting even as the ADS 10, a decrease in the net realizable value of the stock after the reporting period will be normally considered as adjusting even the Zoom Limited. Shall require to value mobile at 4,000 less expense on sale. And there are old due from the debtors amounting 15 lakhs against whom insolvent proceedings was instituted prior to the financial year 31st March. The debtor was declared solvent 15th April. Adjusting even. On the DS10, the receipt of information after the reporting period incident to the assets are impaired on the end of the reporting period, and the amount is previously recognized impairment loss for the asset needed to be adjusted. So the old amount at 15 lakhs need to be adjusted against the insolvency proceeding was adjusted period for the financial year 31st March 2019. Assume subsequent to the year in before the financial statements are approved, the company managed to announce that it is a reconstruction, that operation of the company. Management plans to make significant revenues and close new division of the company business. However, there is no formal plan yet. Should the manager recognize the provision books of account and decide the subsequent end historical company, non-adjusting event. The NDA's an announcement to restructure the operation of the company subsequent to the year end and before the financial statements are approved and non-adjusting event resulting is disclosure. Further, in NDA 37, condition recognize provide that there should be detailed formal plan for restriction. We should have raise a valid expectation in the mind which affects the entity should carry out the restructuring announcement and the main features of the plans to restructure. In this case, there's no formal plan yet, so the provision of the restructuring will be made. It will only be disclosed by way of disclosure note in the financial statement of the year end. An asset is sold to different active market, different prices, they enter into transaction, both market can access the price on the market. The Mumbai market, the price is 290, transaction cost 40, and the cost of transportation 30. So 30 minus 260, the net amount, let's say 220. Kolkata market is 280, and the transaction is 20, and the cost of transportation is 30. Net amount is 230. What would the fair value of the asset in the Mumbai market as a principal market? What would the fair value what value of the none of the market is? Fair value Mumbai market, it will be 290 minus 30 to 60. And in the non-market now it will be 230 Kolkata market. If the net realizable after the expense is more than the export market, say 280, but the government allows 50 percentage for the production to be exported out of India, discuss what is the fair value. The Mumbai market is the principal market of the asset. That is, the market is the high greatest volume activity and the fair cost of the asset using the price would be received in the market and taking out transportation cost. That is 200, 260. If none of the market is the principal market, none of the market is the principal market, then the fair value asset would be measured using the price of the most advantageous market. The most advantageous market is a market maximize the amount that will be received to sell the asset after taking into account transaction cost, the transportation cost. That is net amount would be received on the respective market. So the fair value of the asset in Mumbai market score was 220 and 230 respectively since the entity's maximum net amount that it received in the Kolkata of 230. The fair value is 280 minus 30, fair value is 250. The export market. The export prices are more than the prices in the principal market. It will give highest return compared to domestic one. Therefore, the export market would be considered as a more advantageous. However, if the principal market is available, then the market should use for fair valuation of such a liability. That is Mumbai market 220 and Kolkata market 230. Um, Actually, Limited constructed and warehouse costing 10 lakhs in 2015. The first it became available for Archie Limited on January, and on January 29, Archie Limited discovered that warehouse was damaged. And year during the early February, the investigation revealed the damages was due to structural fault in construction warehouse. The fault became apparently warehouse leaky severely heavy rainfall in the week of January 27. Discovery of fault is indicating impairment, so action would require estimate of requirement amount of warehouse December 31st. The estimate was 6 lakhs. Furthermore, HRSI assessed that the useful life of warehouse 20 years from the date it was ready to use. Before discovering the fault, that they depreciated the warehouse on the straight line method to nil, and the resident value was estimated 30 years useful life. Seepage rainwater through the crack of the warehouse caused the damage in inventory worth 1 lakh became unsaleable. The entire damage of inventory on 31st December 2019. Hatch Limited has not insured against any of the losses. If accounts of all the property, plants, and equipment under the cost model, Hatch Limited is an annual financial statement the year 31st March and approved. You are required to prepare the accounting entries to record the effects of events after the end of a reporting period accounting hatch for the 31st December. Kindly ignore tax. Discuss the requirement of the above recommended days. Will you answer different if there is no structural fault and damage to the warehouse but had caused the event occurred 31st December? Depreciation expenses being additional depreciation recognition for 31st March arising on the reassessment of useful life. Okay. Impairment last to like 47 due to the fault discover construction. The calculation of additional depreciation to charge in the year 2019, original depreciation is 10 lakh 33,000. but carrying amount for 2018, that is 3 years. So 10 lakhs minus 33,000 in 3 years is 9 lakhs. So the revised depreciation 9 lakh into 17 years 52,000. So addition 52,000 minus 33,000 is 19,000. Calculation of impairment losses is 9 lakhs minus 52,000 is 80,000. Recoverable value of aircraft 6 lakhs. So 9 lakhs minus 6 lakhs, 2 lakh 40,000 is 6 lakhs. And damages warehouse adjusted even occurs after the end of in the reporting period of 19 since the providing evidence that structural fault exists in the end of the reporting period is adjusted events. எப்படி வந்து Hmm. Since the benefit is on adjusting, those financial statements are preferred in the good faith and uh, regarding its useful life assessment impairment is not affecting financial or privilege here. Damage of inventory due to the seepage of rainwater 1 lakh occurred due to 2020. It's a non-adjusting event after the 90 reporting period since the inventory is in good condition. Accounting has been done to 90. Has want to be disclose the nature of the event. Yeah, rain drainage to the inventory estimate when just effect 1 lakh and the notes 31st December, 31st December annual financial statements. The damages that has been caused by the event that is occurred on 31st December then was not due of structural fault. It will be considered a non-adjusting event after the end of the reporting is on 19 and the warehouse would be a good condition 31st December was 19. Q was determine the valuation of the thumb of two approach, market approach and income approach. Selected highest and final value of the manager Rhythm is not satisfied. Request to determine the fair value of share of Rhythm Limited. Assign the weight of the market approach and income approach 7 is to 3 ratio. Determine the effect equity value that valuation of market approach 35 lakh 82 380 valuation of income of 31 lakh 930. Debt obligation of the measurement date 996 return surplus and cash equivalent 210,000 fair value of and surplus assets are number of shares is 1 lakh 600 shares. Answer equity valuation to the weight out of 7 is market approach 7 market income approach 3. 35 82 690 32 1 390. Enterprises weightage is 35 70% 20 totally 31 lakhs 30,000. Less debt obligation debt not obligation 9 potage and add surplus and add fair value liability. And 9 lakhs about adjustment on enterprises value share number of share value of share 26. Okay. PQR Limited has acquired building for administrative purpose and presented the same as a property plant equipment in the financial year. During the financial year, he relocated the office a new building and leased the same building to third party. Following the changes in the usage of building, PQR Limited reclassified 22 PP property plant equipment to investment investment property in the financial year. Should the PQR Limited or changes in accounting policy? In the ACA, the policy that application for the accounting policy for transaction, other events and condition that has differ in substances from those previous accounting and not changes in accounting policy. In the A16, property, plant and equipment, tangible items that is held in use and production and supply of goods and service for the rental or other charges are on um, administrative purpose and expected to be more than 1 year. And India is 40 investment property, the property, land or building, or part of the building or both, held by the owner or the lease as a right of the use of asset, earning rental for the capital appreciation of both rather than the use of the production of the supply of goods and service or administrative purposes for sale of ordinary course of business. As per the above definition, and the building is an item of property and the plant and equipment or the investment property of the equity depends upon the purpose for which is held by the equity entity. It is possible that due to the changes in the purpose for which is held, the building that was previously classified as items property, plant, and equipment may warrant reclassification for investment property, vice versa. Where the building is been a nature of property, plant, and equipment, or investment property, determined by applying the definition of the terms as perspective of the equity entity. Thus, the classification of building of the items of property, plant, and equipment as the investment property as not a matter of accounting policy. So, according to the change in the classification of building from the property, plant, and equipment to investment property due to change in the purpose for which held entity is not changing the accounting policy.